Hey everyone, welcome to Property Finance with Lee and part 5 of our Ultimate First Home Buyers Guide series. In today's video, we're going to tackle the biggest barrier to the purchase of your first home, your deposit. If you're new to the channel, I suggest going back to the start of this series as the deposit amount you require will depend on many factors such as whether you get a grant, intend to pay LMI, or enter into an SEA. Don't forget to subscribe and turn on notifications so you don't miss out on the next part of the series. Let's start. If you've watched the previous parts of this series, you would have assessed your financial situation and know how much of a deposit you need to save for. When saving for your deposit, it is imperative to take a close look at your spending patterns. Are there areas where you can reduce expenses or eliminate unnecessary costs? You might consider cooking at home more often or cancelling an unused subscription. Be sure to evaluate any outstanding debts, such as your credit card or personal loans, and develop a plan to manage and reduce these debts over time. Paying down high interest debts should be a priority. Set yourself specific savings goals, determine how much you can save each month, and create a strict budget. There are several budgeting tools and apps out there which will also track your daily expenses. A lot of banks have this built into their online platforms. If your top priority is saving your deposit, a good idea is as soon as you receive your paycheck, deposit your savings target into a separate account. I would even automate this process with a recurring transaction to align the transfer with your payday so it's in there before you have a chance to spend it. This not only helps you save consistently, but also looks good when you apply for a home loan. Lenders may want to see your savings account statement as proof of your responsible saving habits. If you're planning to buy a home in a few years and are comfortable with some risk, you could explore the option of investing in shares or a managed fund. However, it's crucial to seek advice from a financial advisor before diving into these investments. On the topic of growing savings, a federal government incentive you may be interested in to assist you in the saving of your deposit is the First Home Super Saver Scheme. The FHSS scheme is a great way to save money for your first home using your superannuation fund. Here's how it works. You can make voluntary contribution to your super fund, including both before tax concessional and after tax non-concessional contributions to save up for your first home. If you meet the eligibility criteria, you can request the release of these voluntary contributions along with the associated earnings to assist you in buying your first home. There are limits to how much you can release under the FHSS scheme. You can apply to have a maximum of $15,000 of your voluntary contributions from any one financial year included in your eligible contributions for release. However, the total limit across all years is $50,000. Please note, if you requested a release before July the 1st, 2022, when the total limit was $30,000, you cannot make further requests to reach the current $50,000 limit. You can use the contributions released under the FHSS scheme to purchase either a new or existing home in Australia. When looking at this scheme, it is important to consult a financial planner and your accountant. A thorough assessment should be conducted to find out whether this scheme is beneficial for your financial and tax situation. Remember, the key is to prioritize your goal of buying a home and manage your finances in a way that aligns with that goal. At the end of the month, I recommend evaluating the progress you've made. Be honest and keep yourself accountable. And if you find it challenging to manage your finances or develop a plan, consider consulting a financial advisor. They can provide personalized guidance to help you achieve your savings goal. Okay, let's fast forward time. We have saved our deposit and now it's time to use it. How does this happen? Generally, with the guidance of your conveyancer, your deposit will be paid into the real estate agent's trust account during the sales process. The deposit amount can vary depending on the state. For short-term settlements ranging from 4 to 26 weeks, the deposit might not be too hefty, making it manageable with cash. But here's the thing. In many parts of Australia, especially for long-term settlements or when you're buying off the plan, you often need to put forward a whopping 10% of the purchase price as a deposit. Let's imagine you have your savings locked away in a long-term deposit, and you weren't expecting to, but find a property which you fall in love with and is within your budget. What do? Do you withdraw your savings and cop the early exit penalties to pay the deposit, or is there another option? I want to make you aware of something called the deposit bond. A deposit bond, sometimes referred to as a deposit guarantee, is an insurance policy that acts as a guarantee to the vendor that the purchaser will pay the deposit at settlement. Essentially, it replaces forwarding cash to the real estate agent with a deposit bond certificate instead. The benefit is, with a deposit bond, you don't need to hand over cash up front. Your savings can stay put, earning interest while you wait for settlement. Deposit bonds are also great if you're attending multiple auctions, as you can leave the deposit bond amount fixed and fill in the vendor and property details if you have the winning bid at an auction. Be sure to get the appointed real estate agent's consent before using it for this purpose. Deposit bonds can extend up to 4 years, making them great for buying off-the-plan properties. Just check with the developer if they accept deposit bonds. This gives you extra time to save and earn interest before the actual settlement. As deposit bonds have a small upfront fee cost, for medium to long settlements, they are generally much cheaper than missing out on the interest from the cash in your bank. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to catch the next part of the series. If you require a mortgage broker to assist you in your property financing, don't hesitate to reach out through the link provided in the description. Thank you for joining us today. Catch you next time.